Thanks for tuning into this broadcast of The Resilient Advisor. My name is Jay Coulter, and joining me today is my regular contributor, Lenore Hawkins, macroeconomist from Tematica Research. Lenore, thanks so much for coming on.
Thanks for having me.
All right. If for some reason you are new to this podcast, you should know that Lenore is stuck in quarantine in Italy, and she's been there through this whole crisis. Today, we're going to talk about some macro themes. We're going to talk about things you and I really enjoy, but listeners really do want to know. How are things going in Italy? What's it like, boots on the ground?
Well, I'd say people are getting fed up. It kind of cracks me up to see all of the protests going on in the US right now. I'm like, really, please, come on, guys. We've been doing this for 8 weeks and we're still trying to hold in there. But you're seeing where people are just losing their patience. Like maybe 4 or 5 weeks ago, if I looked outside my window, and I live just north of Milan, in the Lombardy region, which has been the epicenter. So I'm just north of Milan in Lake Como. And my home is kind of right in the middle of town, like right against the lake, but in the middle of town. So I see kind of, if anything's going on in town, I can kind of see it. I'm on the top floor. And it was dead silent like 4 or 5 weeks ago. You really didn't hear anything all day. It was very eerie. Just the silence was like, okay, we had the pandemic and everybody's just dead and gone because there's nothing moving. Now you actually see a lot more activity. We're not technically supposed to even go outside unless you're going shopping or to get medicine, just food, medicine. But people are pushing it now. You see people going out a bit more, and the police are kind of lightening up. Technically, we open on May 4th. That's the first day that they're going to start opening up a little bit more. Maybe we will be so lucky as to be able to go out for a walk. Like, that is something to look forward to. I've been pacing my roof literally to try and just get outside. But people are getting very angry and very frustrated, but we had to. I mean, Italy got hit so hard. They think they figured out part of why we got hit so hard was we were the first European nation to get this. We didn't really have a whole lot of good information out of China, which we'll discuss later on as well. But I think what happened was that the first cases they went into the hospitals, and it turned the hospitals into kind of contagion hotbeds where you had doctors and nurses getting sick and patients getting sick, and you just had it run rampant through the hospitals. On top of that, we think we had a super spreader event with a football game between soccer with a game between a Valencia Spain team and Brescia team that was hosted in Milan. So you had like this huge tournament with a ton of people at, and you combine that with the hospitals not doing a really good job. And our hospitals just became overrun very, very quickly. Thankfully, the region here, Lombardy region, is the wealthiest in Italy. It's also got world-class healthcare, some of the best in the world. So people are, they did the best they could do. And we're finally seeing light. Our case count has been going down pretty regularly. It's fits and starts, but it's been like lower lows and lower highs. So hopefully we'll start coming out here soon. But, like everyone else is facing, what's the second wave going to be like? Because we're going to have to learn to live with this virus for probably a long, 18 months, maybe a year at the very least, right? Until we get a vaccine.
So if you see more people outside, what are they doing if they're not going to the grocery store or to get medicine?
Just going out for a walk. I mean, we've been imprisoned for weeks. We have to wear a mask when you go outside. If you don't, the police will stop you and put one on you. If you want to go into a grocery store, you definitely have to.
They'll put one on you? The police are walking around with masks and forcing them on people? Wow.
Yes. Wow. You have to. They're pretty serious about it. And they will also stop you if you go anywhere near another person. You have to maintain the 6 feet apart from other people. Mm-hmm. Technically, we're not allowed to visit anyone. You can drop groceries off for somebody who, is maybe too high risk to go outside. You can drop groceries off for them, but you're not supposed to see them.
So do you see people breaking those rules?
We're starting to, yeah, a little bit. Like the other day, I was spying from my balcony, and I saw people talking to each other. I was like, "Oh, good for them."
Yeah.
they were coming within like less than 6 feet away from each other, and it made me so excited. Just to seem normal.
Lenore, you guys have been in this much longer than we have here in the United States, and it's been much harsher. And I always ask my guests to not put a political slant on any of the conversations we have, just because there's not a reason unless there's an economic context to it. But here in Atlanta or in the state of Georgia, the governor has opened up the state starting today. So if I wanted to go out and get a tattoo, if I wanted to go bowling, if I wanted to get nails done or haircut, you technically can go out, not technically, you can go out and get it done today. Based on the experience you've had and what you've watched unfold across the globe, what are your thoughts on that?
I hope it's not too soon. I mean, it's interesting to see different countries that have handled it. So for example, Sweden and the UK both had the herd immunity. Let's just, let's let it go and we'll see what happens. And hopefully not that many people die. It's working out so far for Sweden. It didn't work out for the UK, and the UK had to quickly reverse course because their hospitals became overrun. Same thing that happened here in Italy, same thing that's happening in Spain. Sweden hasn't had that experience. Then again, Sweden is a little bit more of a not closed in any political sense, but you don't have nearly the kind of international travel in and out of Sweden that you do out of, say, Milan and Rome. So that's part of it. Plus, Sweden has fairly low, outside of a few cities, it has fairly low population density, which really helps. Now, I look at Georgia, it's not exactly a state that's got low population density. And I think the real struggle there is going to be what Sweden had is the people there respect their government, which is a real big problem in a pandemic if people don't respect and trust their government. So when the government said you need to do social distancing rules, you need to be wearing masks and all that, people did it. I'm seeing people in the US not doing that. And I think that's going to be quite likely a very big problem. People in Italy so far have been doing that. That seems to be helping with the cases a lot. But I think if people in Georgia, it's tough. If you haven't been through a lockdown for an extended period of time, I think it's the longer you're in a lockdown, the more your behavior patterns are likely to change for some period going forward. You guys haven't had much of a lockdown for very long. So I think people are going to go right back to just business as normal. And we can't. God, I wish we could, but we just can't because this thing is so damn contagious. And a good portion of the people who get it need to be hospitalized, and there aren't enough hospital beds, right? So I worry that, and then I think the impact, if you have a state open up and then have to close down again, I think that could be very disruptive for business and very unnerving for people.
And that's a great pivot into the implications of all this. Record-breaking economic decline. Let's just start high level. What's your take?
Well, interesting what we saw this week. We saw oil price down to nearly negative $40 a barrel for WTI. That's like, what? You got paid to take a barrel of oil. That's new. That's brand new.
Hard to model that. Nobody had that in their models.
No, we're breaking all kinds of rules. We already went to like negative interest rates. Now we've got negative oil prices. Oh my God. This was not in my MBA program. We didn't cover this in the finance class. But what else are you going to have when you've got an inventory filling up and we're not using that much, right? Who the hell's driving to work these days? Who the hell's getting on a plane? We're down, talking about the economic realities. We have where plane travel is down like 95% year over year. They're not burning any oil, right? We've seen across the board economic contraction that is at record levels, right? The first recent 5 weeks, we had 26.4 million unemployment initial claims. That's 3 times the total losses we saw in the financial crisis, like 3 times. And we got that in 5 weeks. That's wiped out all the gains we had since the financial crisis. If you look at the Economic Research Institutes, I'm a big fan of their weekly economic indicator. It is showing that we have the worst global economic conditions on record. And it kind of implies roughly for the United States a 7.5% quarter over quarter contraction in GDP. That translates to about 30% annualized. Now that's we're talking the Great Depression, right? Like we're talking way back then. And yet, if you look at the S&P right now, well, S&P is unbelievably pricey. We've got the market cap, if you look at the total market cap to GDP, is in the 90th percentile. Looking at the S&P 500, it has tried to push up against the 50-day moving average 3 times this week. Couldn't quite do it. And that's even with about $8 trillion and counting in stimulus that's been thrown at it, right? So no wonder the market is still trying to go up. But when people say, well, you know, it's probably priced in, we already took the market hit, like, you've got to be kidding me. So we have some of the worst economic conditions on record, and yet the Shiller cyclically adjusted PE ratio is in the 91st percentile of all time. So that's like what, top 10% of all time. It's that expensive. And you're facing some of the worst economic data we've ever seen. Looking at the total market cap for all of the US traded companies to GDP, it's in the 90th percentile. If we look at corporate profits as a percent of GDP, the last number I looked at for that was last available was the end of last year. That's in the 81st percentile. I mean, so corporate profits still were super, super high, right? And so that's corporate profits are really high. They're only going to go down, right? We're not going to increase what corporate profits are as a percent of GDP. That's not going to get better. You've got prices that are still astronomically high. I mean, none of this really makes any sense. And then if we look at what's kind of going on underneath it, we're not seeing yet the pain. We're starting to get a little bit, but what we need to start seeing is a lot of bankruptcies, because going into this, we had an unbelievable record high level of corporate debt. Right, we've got there was like 10 trillion in non-farm, non-financial corporate debt in the fourth quarter. So that's all not going to go well, and we're starting to see the first indications of that. The S&P has made 125 upgrades so far this year, but 1,270 downgrades. That's more than a 10-to-1 ratio. And that's because, right, that debt's not looking so good. Tough to service your debt when you've got no cash flow.
So, Lenore, let's go back. I'd like to go back to the Shiller PE ratio. It's in the top decile of its historical numbers. Price, earnings. This isn't even taking it, because the PE ratio, the Shiller PE ratio, is backward looking and adjusted for inflation, not forward looking. So this is going to be dramatically, potentially higher as the E starts shrinking in that ratio, right? Yeah. Which would require either the P to go up or the P is going to go down, right?
Yeah, exactly. Because you usually see it spike up and then go crashing down, right? Like you on their chart here, you have Black Tuesday, Black Monday. When your earnings go crashing down and the price hasn't really caught up yet, if your earnings get cut big time, then your PE ratio is still high. But then eventually investors look at it and go, okay, I'm not sure why I'm paying so much for earnings going forward. And I think one of the things that's going to be interesting as we see that, when you look at all this debt out there and then you look at all the stimulus and people are saying, oh, well, we're going to be seeing inflation. I think it's actually going to be very, very difficult to get inflation, because it's exactly what we need desperately, right? You need inflation because that reduces your debt load, because your debt is priced in like yesterday's dollar, right? Is priced in these cheaper and cheaper dollars. But I think that's going to be very, very difficult to get when you have so much debt out there. Mm-hmm. I think we're probably going to see the yield actually plummet much further down. I wouldn't be surprised to see the US 10-year go negative. It's happened in Europe. It's probably going to happen here.
Yeah, there's a lot of precedent for that. What do you think the implications are for the U.S. credit markets then? And also putting the lens on the fact that the Fed is now buying U.S. corporate credit, even junk, through ETFs.
Even junk. Yeah. Well, that tells you how bad it's getting. I mean, they didn't just do that for the fun of it. They saw that the spreads were really widening, and going into this, so this kind of, we have to look at what the world looked like before the pandemic hit to see, well, what's going to happen now. Before this happened, we really had a house of cards. You had about 16% of US companies were zombie companies. And that means that they didn't generate enough cash flow. And that's when times were great. They didn't generate enough cash flow just to service their debt. So these were companies that were going back out into the public market and they were issuing debt just to service their existing debt. Right? 16% of US companies, about 12% of companies worldwide were in that condition. That, talk about a house of cards coming in, but that's kind of the natural consequence of having these really, really suppressed interest rates. So investors were desperate to get any kind of extra yield, and that just made all this free money. You couldn't fail, right? One of the most important parts of a market is to have a business fail, right? You want times, right? You want
capitalism. Yeah.
Exactly. You desperately need failures in capitalism, because that frees up money and it frees up people, resources from a company that's not really well run, or it's a very bad idea. It shouldn't exist anyways. And it frees that up and it moves it over to something that is much more productive. And it's one of the reasons we've actually had such low productivity. And with that low productivity, that's why we've had such slow economic growth. Because to grow an economy, there's just two things. You grow either the labor pool. Well, that's barely growing. I mean, we've gone down where the US used to have its labor pool growing like 3 to 4% a year. We're now down to much less than 0.5%. And the more we cut immigration, not forget any political issues, it's just if you cut immigration, that just means that your labor pool is going to grow even more slowly, because Americans aren't having enough babies. So if you don't have enough babies, your population's not growing. So as we look forward, when we look at that, like the productivity has been really low, because you've had a lot of companies that shouldn't have been in business, stayed in business because they could issue all this debt, and you have a really slow labor pool. And now what do we have? Well, now you've got economy in total lockdown. So those companies, they're not issuing more debt. They're not getting any cash flow. So we're going to start seeing this slew of bankruptcies. And we desperately, even though those bankruptcies sound awful and it is painful for people, right? Nobody wants to see their company go bankrupt, because that makes your job a lot more difficult. We need to have these bankruptcies happen. And you're going to see them occurring in the weakest links of the economy. So definitely one of those is going to be oil, right? When you're down to negative prices. But we're also seeing
hard to make money, Lenore. Hard to make money with negative.
Hard to make money. It's like we have negative gross margins. It's tough to come back from that. But we're also seeing it in a part of the economy that we already knew was very weak. That's in the malls and the retails. Gap has announced that they've burned through half their cash already, and that's after drawing down their entire line of credit. They didn't pay rent at all in April, which I really think was actually a good move for them, because they probably want to get the hell out of those malls. Thinking about this going forward, unless there's some miracle, and I'd love that. I'd love to have a miracle. I'd love to have this whole pandemic just go away and we get like some treatment or some vaccine and we don't have to worry about it anymore. Great. But so far, none of the virologists are saying that that's likely to happen. So I can't count on hope. I got to count on what seems more likely, and history would tell me that we're going to be dealing with this thing for a while. And how likely are people to want to go to the mall and be around a lot of people if they're still worried about this virus? And I think that's
people weren't going to the mall before the virus too, Lenore. I mean, that was
exactly
already in a trend where people weren't going to go and spend a whole lot of time there. My kids, I've got a teenager now. When I was a teenager, I wanted to go to the mall with my friends. Boy, that would be torture for him. He'd probably rather do work than go to the mall. Before we move on from the U.S., here's the question I get multiple times a day from financial advisors who build portfolios, thoughtful portfolios for their clients. Yeah. They're looking at these valuations. They're looking at the news that you and I are just discussing. It's hard to circle all that up. And I'm not asking you for investment advice, but what type of lens should advisors put on these portfolios they're constructing with valuations at these levels?
You've got to be really careful. I would say it's highly unlikely that we do not get another major downturn. And history would be on my side with that. For example, during the Great Depression, which the market downturn there started in October of 1929. Between October of 1929 to June of 1932, the S&P lost 85%. But in November of 1929, you had this rebound from November of 29. So a month after the whole crash started, you had a rebound in November of 29 through April of 1930, where the market rose 24%. Sound familiar? It then crashed again after that, and we didn't actually return to the 1929 levels until 1954. So to see these bounces back up is not unheard of. I think
Hey, Lenore, before you move on from that point, I just threw up a chart that I had it handy because I've been using with advisors for a month and a half now.
Yeah.
And it's the Dow during the crash of 29 all the way through the Great Depression with the 200-day simple moving average laid over.
Yep.
This is not an investment recommendation, but it's very clear that in that market, that was a great tool to keep you from trying to catch the proverbial falling knife or getting head faked by any rise in the markets. But if you look at that chart, and my apologies to podcast listeners, it went on for 3 years.
Yeah.
We weren't able to get above that 200-day moving average.
And we're not prepared for that. I mean, we've just never really seen something like that. And I don't think we will see what we went through in the Great Depression, just to be clear. I mean, the Great Depression had a very different set of dynamics than what we're dealing with here. Some good, some not so good. One of the things that the Great Depression did see that we are seeing this time around is a big time rise in nationalism. And that, I mean, what we are seeing is a big shift into kind of de-globalization. We're seeing where international organizations that during the financial crisis were actually respected, people were turning to them for help, countries were kind of working together to get out of this mess. We're seeing the exact opposite. Over here in Europe, you've got a lot of tension in the Eurozone. And this really, the next couple of years, is going to be make or break for the Eurozone. When it hit Italy and then when it hit Spain, the northern countries just looked like, ooh, everybody, instead of really jumping in there and helping, countries locked it down and they kept their equipment for themselves. Now, I understand that. What leader wants to say, oh, shoot, sorry, I'm Angela Merkel and I just gave all of our extra ventilators to Italy. I can see why you would do that. But that really destroys the trust in the European Union because you didn't have it acting as a union. If in a crisis, it's not acting as a union and it's everyone for themselves, then really do you have a union? And right now, there's all this pressure because there's no way that the southern countries that have been hit the hardest, that Italy and Spain, can actually get the debt that they need to borrow to support their economies. So they're pushing and saying we need to have these euro bonds. And what the euro bond is basically is that there's a disproportionate benefit from the bond than there is a payment for the bond. Because right now, Italy issues its own bonds. It has to pay them, and that money goes to Italy's economy. A euro bond would mean that the European Union would issue a bond, and a bunch of that money would go to Spain and Italy and Greece, right? And that would mean that Germany and the Netherlands, which is really against this, that they would be paying a disproportionate relative to the benefits that they're getting out of it. That's one of the reasons you saw the European Central Bank just followed the Fed, now starting to buy lower and lower grades of debt. And they've kind of blown through their rules on how much debt they can buy of any particular nation because they need to support Italy's debt levels because Italy needs to spend an insane amount. I mean, Italy's going to be going through a big depression and that needs to be supported with government spending. Where the hell are they going to borrow the money from? So we'll see that Eurozone was much tighter in the financial crisis. And this time it's kind of breaking apart. You have a big,
Hey, Lenore, is there anger inside of Italy now towards these other nations?
There is so much anger and hurt, actually. I think one of the most profound comments I heard was from a politician in Italy who has been extremely pro-Eurozone for years. Said, what did we do to Germany? Why do they hate us? Why do they want to hurt us so much? And that's the feeling. It's we didn't do this. Like literally, I mean, you can fault Italy for a lot of things. And Italy, I mean, I kind of hope that there's some sort of a takeover of Italy's government because Italy does not manage its own finances well. There's no argument there. None at all. I wouldn't mind if Germany stepped in a little bit. I mean, the Italians wouldn't be happy about that, but I think it might turn out a little bit better. But this was not Italy, right? This was a pandemic, and it just happened that it hit Italy first. And it even looks like if they're tracking the DNA, it even looks like a lot of the contagion in Italy actually started out of Germany, not this whole rumor that's going around about Chinese people manufacturing clothes in Italy. That it turns out that that's not. They have the Chinese in Italy actually have one of the lowest incidences of the coronavirus within their own population. So that's clearly not where it started, even though that was a very popular article going around that wasn't really what
I remember
happened.
reading it. I remember sharing it.
It sounded good, but they've looked at it, and then that if it came from the Chinese immigrants, then you would have a lot of Chinese immigrants with it. Well, you didn't, because one, they're kind of like, when you look around in Asia, they're more versed on these kinds of pandemics than we are. Mm-hmm. They're real quick to do all the protective measures because they've been through this before. They've been through SARS, right? So they know the deal. Whereas everybody here was more like, "Why are you wearing a mask? What's wrong with you?" Mm-hmm. And we're kind of over that.
So Lenore, you're talking about intracontinental anger. Mm-hmm. Twice last century, that did not end well. Is there any concern about shades of the past coming back?
I think there are reasonably concerns. What I'm hoping is that we have such a globally interconnected economy, not maybe so much. I think the supply chains are going to change. I think China is going to be in a world of hurt. I mean, you've got Australia calling for an investigation into how China handled it and what China told the rest of the world. You've got a hotel in Italy is suing China. You have the state of Missouri suing China. And I think we'll probably see a lot more of this because the data is coming out that clearly China didn't really give the rest of the world the full story of what's going on. And this is nothing about the Chinese people, that's not about the Chinese people. This is how the Chinese government chose to share information with the rest of the world, and that its lack of sharing could have really made this thing a whole lot worse for everyone than it needed to be. Mm-hmm. So you see a lot of this deglobalization going on, and I think you're seeing where at a time where supply chains are already massively on hold, and when they get kicked off again, it's going to be interesting to see just how they are changed, because I think we're going to see a lot of supply chains are probably going to come back into domestic markets, which could it'll hurt in the beginning, but it could be good for the US in a long run. And I think we're going to see a lot of political changes because we are really facing a world war. It's a world war, not against countries, but against a virus. And whenever you have these massive economic upheavals, massive battles, you usually see enormous regime changes. And this comes after a period of subpar growth, right? So no one's particularly happy about it.
And suffering.
And suffering. So we're going to see a lot of changes, I think. And looking on the bright side of this for the United States, one of the things that this pandemic is helping really question regulations. And that's a really great thing, because remember we talked about how to grow an economy, it's a function of the growth of productivity and the growth of the population. Well, heavy regulation really hampers productivity, and it also protects incumbents that maybe should fail. And what we're seeing with regulation is things like telemedicine, things like a doctor, because a doctor is only licensed to practice in one state. Well, a lot of states have been waiving that now, saying, well, New York particularly, we need doctors. So, okay, here, you're fine. You're licensed in California. Please come and help us out. We're seeing the rise of telemedicine, both for humans and actually for pets as well, because this virus is sort of the gift that keeps on giving. This thing is the weirdest virus we've seen. A couple of weeks ago, we had where there was 4 tigers and I think it was like 2 or 3 lions in the Bronx Zoo got the coronavirus. Well, we've now just had on earlier this week, 2 domestic house cats in New York got the coronavirus.
Well, Lenore, what I don't understand is it's hard to get testing here in the United States. How are
cats? How the hell is a cat getting it? Well, now, because of that, they're actually opening up telemedicine to veterinarians, which was that's a first as well. So we're getting rid of some of that regulation. And I think when we look at what could happen with productivity, we've had a lot of really amazing technology that we're now saying, oh, thank you, God, because it's really helping a lot of companies keep their operations going. For example, like Cisco, they have about 70,000 employees, and they've moved all of them are now, almost all of them are working remotely. And they say they're planning to keep it that way for the foreseeable future. And that could be really great in a couple ways, not so great for REITs in office space, right? But that's great for the company because it can help reduce their fixed overhead, right? Office space can be a huge expense for a company. They can reduce that fixed cost. Maybe you have people coming into the office like once or so a week, keeping them offsite as much as possible. We're being forced to use tech that we had, but we didn't have to use it. And now maybe we're going to learn ways to be more productive, reduce commute times. That reduces pollution. You're increasing people's ability to be productive from anywhere. And that can really kind of jack up our productivity. Whenever we've gone through these horrible periods of unbelievable economic pain, while awful and not something you ever want to go through, that's also when we see unbelievable levels of innovation. And we've really been stagnating on that. This is going to force people to get very creative with solutions. You didn't need to get creative with solutions. You didn't need to innovate because money was so damn cheap. That's all changing. And I think another one that could help our productivity is the health impact, right? So on average, about 5 to 20% of the US population gets the flu every year. And the CDC estimates that costs us about $87 billion annually. I doubt that we're ever going to look at the flu the same way again. I don't think you're going to have people coming into the office when they have a cold, right? The companies are really going to change the way they behave towards that. We're going to change our attitude towards when somebody gets a cold. And maybe that can really kind of reduce the burden on the economy from the common cold.
Yeah. Those are definitely some areas for optimism. You know, Lenore, we've gone way over our time, and I appreciate you spending some time with us here today. It's always insightful to get your thoughts on the macro economy and, of course, life in Italy. I do have a new segment I'm doing with guests, and I'm going to put you through it as well. It's called Just One Stock. It's not investment advice, but if somebody came to you and said you have to put your whole net worth into one stock and hold it until retirement, and you had to pick that stock right now, what would that be?
Maybe OLED, the Universal Display.
What company?
OLED, Universal Display, OLED.
OLED.
Yeah, because you've got, so looking forward, we're not really going to unlearn a lot of the things that have had to change. So I think you're going to see more remote working. You're going to see a rise of like 3D printing and robotic technology, right? Because we're going to bring a lot of manufacturing is probably going to come back domestic, but you don't really want to be using a lot of people for that. You're going to be using robotics, and all of those are going to involve screens, right? You're going to be having more and more of the automated supply chains, 3D printing, where you're going to have production is going to be closer to the end consumer, and all of that's going to need screens.
Excellent. And listen, next time you come on, you can change that pick. But for today, it's OLDE. Lenore, thanks so much for coming on the show.
Thank you.